Hi, I'm Adam Brown of RE/MAX Hallmark. Today I'm joined by Morgan Vaughan of Capital Home Lending to talk a bit about interest rates. In the past few weeks, we have seen many chartered banks forecasting multiple rate increases over the next 12 to 18 months in an effort to slow rising inflation. So Morgan, should mortgage interest rates continue to increase over the coming months, what would be the best strategy for homeowners to implement, in your opinion, to put themselves in the best possible position for the future?
Well, that's a great question, Adam, because the question is when are rates going to go up, not if they're going to go up, because we can all see that with all the economic indicators, rates are going to go up. And I'm talking about variable rates in particular, because that's the big question. People want to know, should I take a variable rate? Should I take a fixed rate? We're seeing the biggest spread between variable and fixed rates that we've really ever seen, that I've seen in my 20 years of doing this. We're seeing variable rates in the low 1%, 1.2, 1.3% versus fixed rates today that are 2.5 to 2.7% really, depending on the situation. And a lot of people are saying, should I lock in at this higher rate or should I lock in at this low variable rate? So when you take a variable rate, you're subject to the discount off of prime, but prime can change. So prime is going to go up. A lot of economists feel that might go up 1% over the next 12 to 18 months. And the big question is, how can I benefit from this low rate? So what I'm telling every client really is that if you're going to take the variable rate and you're going to take the risk that your payment and your rate could change a little bit, consider what the payment is on the fixed rate that you're going to take. So if your payment, as an example, is $2,000 a month on a 5-year fixed rate, but the equivalent payment on a variable is only $1,600 a month, that's a difference of $400. So set your payment at $2,000 a month and take the interest rate that's at 1.2 or 1.3%, because that extra $400 a month on top of the extra savings you're getting from the low rate is strictly principal. So you could have a 30-year mortgage that could end up being 23, 24-year amortization right from day one. And the biggest benefit is that if rates change, which they're going to a little bit, your payment will be the same. And all that's changing is the allocation of interest and principal. And that's a huge swing because a lot of people will take a variable only for the low payment. They won't take it for the actual benefit of having a low rate. And that's the biggest advantage that most people don't consider that I think they really need to be honest with you.
Right. Good, good. I think that's really good sound advice, especially in this current unpredictable time in the market. So if you have any further questions about this, please feel free to reach out to myself at info@adambrown.com or at Morgan. Morgan, where can people reach out to you, either through email or through through your website?
Yeah, my cell phone's 416-436-0179, and it's morgan@morganfinancialgroup.ca.
Well, I hope that's been a little insight for you guys today, just to be able to get a sense of where things are at or what the best way to take advantage of maybe an environment where you're starting to see interest rates rise. Please stay tuned for our next Homes Gazette coming up in January 2022. Thanks so much.